We're very excited when the market cap reaches 100 trillion yuan. That's really a milestone.
This one does feel different, not because of the number alone, but because what's driving it.
For the moment, it's a very, very solid base that China has developed here.
And this time it feels more measured, greater transparency, and investor accountability. That's real.
It's a positive change for China, but there's still potential upwards.
The overall bull market can be more possible to last.
The Chat Lounge. Chat Lounge.
Chat Lounge.
The Chat Lounge unpacks views and opinions on hot issues in a more casual way.
Welcome to the Chat Lounge. I'm Yun. Joining me to discuss China's A shares reaching a decade high, Professor Hans-Peter Burghof, Chair of the Banking and Finance Department, University of Hohenheim, Germany. Frank Liu, Associate Professor of Finance, Business School, University of Western Australia, and Chen Jiahe, Chief Investment Officer, Beijing-based Novem Arcae Technologies. Great to have you all at the chat, gentlemen. So China's A-share market, made up of the Shanghai and Shenzhen stock exchanges, has hit a historic milestone. For the first time, its total market capitalization surpassed 100 trillion yuan, which is nearly 14 trillion US dollars. So let me begin with our investment expert here, Jiahe. How excited were you when the market hit the milestone? And may I ask, in what ways has your company benefited from it?
Yeah, we're very excited when the market cap reaches this 100 trillion yuan. That's really a milestone. Started from a very small market back about, I think it's 3 decades and a half ago. And now we are, at this size, have about 6,000 stocks in the Shanghai and Shenzhen markets. And if you include other smaller, over-the-counter markets, you get about 10,000 stocks for you to pick. It's really amazing. I mean, the stock market right now is a very important composition of China's overall financial markets and the economy. I mean, if you look at the banking sector, they got the asset about 300 to 400 trillion yuan. So that means stocks is like, say, 20% of China's overall financial market, which is really large. Well, regarding ourselves, we are basically a family office that we invest our own. I think we got a few 100 million yuan in the markets, and we just bet our money in it to the companies that we think are strong and stable, and buy the stocks at lower prices. And we keep on benefiting from this market. I mean, we rarely lose much money in any single financial year. We made approximately 40 to 50% last year, and this year we made about 25%. So that has been, really where our money really comes from. So it's really, really important for us.
And to Frank, we've seen rallies come and go. I bet you've been following the Chinese stock market very closely, though you're in Australia. When we look at today's 10-year high in China's stock market, what feels different this time then?
Well, this one does feel different. I mean, not because of the number alone, but because what's driving it. We are not seeing the kind of euphoric margin-filled speculation that we saw back in 2007 or 2015. Back then, markets doubled in a matter of months, and we all know how that ended, right? And this time it feels more measured. And to me, what is really important is that we're finally seeing the early results of deeper reforms. We can see dividend payouts are stronger, the IPO vetting is tougher, and regulators are taking fraud seriously. So as someone who studies market institutions in China, even though I'm based in Australia, I'd say this is a turning point. Historically, concerns about weak investor protection and short-termism held back global participation. But the shift toward greater transparency and investor accountability, that's real. And that is building long-term credibility. So that's why I think this time is different. And just onto your first point regarding the 100 trillion yuan point, I guess, it is a headline number, and it's also symbolic. It shows that the Chinese equities have clawed back lost ground over the past decade. And there are real financing implications as well, right? We see that, just read from the news the other day, the direct financing through equity and bond markets has risen from 27% in 2018 to over 31% today. And that means all the companies have better access to capital markets. and less reliant on bank lending.
Right. Great to see higher confidence in the Chinese stock market from overseas. Yeah, Frank just mentioned the cap 100 trillion yuan, but Hans-Peter, the number only stands at around half of the total market cap of the New York Stock Exchange. And also, the Shanghai Composite hit a 10-year high. It might sound impressive, but at some 3,700 points, the index was only some 60% of the highest level reached in 2007. Besides, the market has expanded significantly over the past decade. So quite a few stocks still haven't reached the level they were 10 years ago. So from your point of view, how significant is this?
That's how it should be on a stock market.
All
Some
right.
companies are successful and they're gaining ground, and some companies are not successful and they're losing ground and losing in prices. And that's a good thing to see that, because if everything would go up, there's definitely a bubble. I mean, we have to discuss later on how much of what's happening now is a bubble, not only in China, but in the whole global markets. Because if you talk about AI, there might be components of a bubble in that. But I think that's quite normal that some shares will lose and some shares will win. For the general development of the market, it's what's really impressive is a large number of companies participating in the public market, even more, if I see it rightly, than in the United States. So this is second largest by capitalization, by market cap, and as I see it, the largest even with regard to the number of companies. This is very impressive for sure. So the market is not growing because prices go up, but it's, I think, mainly growing because there are a high number of companies entering the market, which diversifies the financing possibilities for companies. That is a valuable asset. I think that's a good one.
Like you just said, it's in part the result of an expansion of listed companies. Then I'm asking all of you, what's driving or other factors driving this market to its highest level in 10 years? Some people say they're more about the quantity rather than the quality of the company. Is that so, Hans-Peter?
Oh, there's always a shakeout after such a development. For sure, maybe there are more companies in the market than should be for some time,
Right.
and some will vanish, and then the good ones will remain. So such developments are quite normal. We see in the IPO market in other countries. I don't know about China, but I'm sure Frank might know much more about than I do in this respect. But you always see these phases where a lot of IPOs come to the market because the valuations are so positive, the investors are so receptive, they like this. And then everything gets financed better on the capital market than anywhere else. And so everybody goes there. And then after some time, we find out for some of the companies, this was not such a good idea. So I wouldn't be too depressed if some of these companies will leave the capital market. And that's a normal development. But having this potential to grow and lead more and more companies to the financial market, that's a good thing, I'd say. And this, I hope, will stay. I mean, this depends on many other and also the framework aspect. But for the moment, it's a very, very solid base, that China has developed here.
Frank, you got more information there?
Yeah, I mean, I just want to have a quick comment regarding the quantity versus quality things, right? Remember the market, the function of the market, as what we learned from the fundamentals of finance, is there to channel funds from people who need the money from people who have access to capital to people who need money. And then the market is there to serve the very function of price discovery. So I don't see a point, I don't see a downside for having a large number, right? Like obviously, with the larger and the more quality, it is better, right? But back to the point regarding the major driving forces of this recent rally, I think personally, I think that is driven by a mixture of structural and cyclical factors that are coming together. So first of all, just to address the elephant in the room on the geopolitical side, that the easing of U.S.-China trade tensions has lifted a major overhang, right? And we are seeing more constructive dialogue, fewer threats of tariffs or delistings, and that's boosted investor confidence, especially among the foreign investors, right?
Indeed.
And then, also the domestic momentum is stronger than expected. The GDP grew, I think it was 5.3% in the first half of 2025. Correct me if I'm wrong, right? Which is about forecast. And policy support has been smart and targeted, right? And third, which in my very own opinion, is that we're seeing some real excitement around innovation. We're seeing EVs and AIs get a lot of headlines, but I wanted to flag something often overlooked, which is the pharmaceutical industry reform. Beijing has been pushing for high standards, faster approvals, and pricing reforms. And I think that has unlocked value across the whole sector, particularly for firms focused on innovative drugs. So I think earlier last month I read a review by like an industry report by McKinsey. China's pharmaceutical innovation market is expected to double within 3 years' time, and the capital is already rotating, right? So I think that's all that plays a big part in driving the recent rally.
Right. Jiahe, which factor do you think has played a bigger role in boosting investor confidence, easing trade tensions with the U.S., rising domestic demand, or anything else then?
Well, so the trade tension with the United States is no longer a factor that is actually influencing China's stock market today. I mean, this trading conflict has been there for almost a decade since the first time Trump got into the White House. And, for stock market or financial market is that if there is something surprising you never met this before, then you would be worried. But if something has been there for 10 years and the economy is still growing at 5.3%, as just been mentioned, you're never worrying about this at all. I mean, and if you look at the economic side, is that many Chinese companies have started to withdraw their businesses from the United States. If you look at China's export of electric vehicles, for example, most of these exports go to Southeast Asia, go to Europe. Well, very few of them go to the United States. So that means the trade tension between the US and China is no longer that important. I mean, we have been investing in some port companies. We have went on to ask the listed companies about how much impact would there be if there is no trade between China and the United States at all. If all the trade goes to zero, how much would that influence your shipping business? And the answer is around 5%. So you can see this is a really small number, even if there's no trade between China and US. Of course, this is not real. There's always going to be trade. So we can see the impact from the United States is really small nowadays. And people are confident about the stock market is basically because the economy has been kept on growing for many years. I mean, even amid the pressure from the property market, we see that the economy is still growing at around 5%, which is really amazing. This tells you how strong the domestic market really is. And that's why people are really coming into the market. And another reason is that China's stock market has been underperforming for quite a few years. If you look at the performance of Shanghai and Shenzhen 300 index, for example, its performance has been lagging behind the SP 500 in the past quite many years. And for stock market, there is always fluctuations. It goes upward and goes downward. So if you see a market has been underperforming for quite a long period of time, and its economy is still growing very stably, then it's very possible for you to have a bull market. I mean, that's why I think that's the main driver behind the growth this year that we can see with many stocks.
So you value the economic fundamentals more than geopolitical reasons.
The Chat Lounge. The Chat Lounge unpacks views and opinions on hot issues in a more casual way.
Well, now that we've set the stage, let's look at how the market is moving and who's driving it in terms of industries. Jiahe, which sectors are leading the charge in the market boom this time?
Well, if you look at what's going on with the recent market rally, we can see that the tech companies is definitely one of the very important sectors. I mean, people are really amazed by those many new technologies that Chinese companies are working out. I mean, if you are living in China, you can really feel that your life has been changed so much by technologies in the past 5 to 10 years. Life has just been made so much easier because you got your smartphone, you got your network and everything. It's just easier. I mean, it's easier in every aspect, your consumption, your traveling, even you go to do some paperwork with the government. It's much easier with all these apps and electrical procedures. So technology is definitely what's being chased by the market. But that's also creating a small problem is that because too many people are rushing into the technology companies because technology industry, if you look at that, it's a very volatile market. I mean, companies don't stay in the same position every 5 years. So the market is really volatile. So the investors jump in and they buy the good companies with very high valuation. That's creating a problem because they're probably paying too much for some of the companies. But overall speaking, technology is a main driver of China's capital market. Another driver actually comes from the consumption market, is that because if you look at China's consumption, it's growing at an amazing speed. I mean, look at PPMT, the company that was selling a little dough called Labubu. Its profit grew by 200% in the first half of this year. So that's amazing. I mean, you earned 10 billion last year, you make 30 billion this year. So that's really amazing growth speed, and people rushing to buy these companies as well. But that's also creating the problem of evaluating. So that really depends on how you look at these companies.
I was expecting, the banking industry, one of your favorite, right? They're not doing well this time.
My favorite would be different from the market's favorite. Frankly speaking, I think that's making my performance different from the market. That's why we beat the market every year.
All right.
We know what the market likes, and we study these industries. We just find so many people are rushing into them, and it's too difficult for us. So we kept on looking for more traditional companies with very favorite valuation. That's our style. I was just talking about what the market was like. It's not something that we would like. Currently, we have about 30% of our portfolio in banks. I mean, we were having about 50 to 60% back 2 years ago, but because the banks have been rising quite much in the past 2 years, so we reduced our position to about 30 to 35%. But they're still very strong companies selling at about 5 times, 6 times PE ratio, giving you a dividend yield of about 5%. So that's still good. So we're still holding about 30 to 35%. Another portfolio we are having with is the port companies. We've got about 25 to 28% of our portfolio allocating with the port companies. They are cheap and they're really competitive. It's really hard for you to beat a port company because they hold the geographic monopoly. It's not only something about the money or the business model or license. They just are holding there. That's the only suitable port you can have alongside the coastline. So this is what we call competitive advantage. So we hold quite a lot of companies here. And we also hold about 15% of our portfolio with the medical wholesale industry, which is an industry that is not amazing at all. They earn about 9% return on equity every year, but they're trading cheap in about their 0.6 times PB ratio. And their competitive advantage is really strong. I mean, it's really hard for any new company to enter into this industry. So we think it's a fair trade for us. So we got this as well.
All right.
May I ask a few questions on this? I mean, talking a lot with different investment managers from family offices of investment companies here in Germany. A lot of time they tell me their strategies and everything. And the German market and the German market is not the best I know of. It is much harder for these people to beat the market than it seems to be for you. It's a bit troubling to me because simply going away from bubble parts of the market and going into solid basic things is a good strategy, but everybody else can imitate this strategy.
Yeah.
Seemingly for you this works. And you say you beat the market every year. This means it works easily. Yeah? Is this a sign for a lack of, or should I say, efficiency, informational efficiency of the Chinese market? Is there still too much bubble parts where simply there's not enough people doing arbitrage strategy, doing counter-cyclical strategy, things like that? Is there still a signal that the market is not really ripe, that in this growth tendency, there is still a lot of information inefficiency?
Well,
from the outside, I can tell you there is. For Germans, the Chinese market is far away. For it, it's difficult to really understand what's happening. And I would assume most German investors would just buy the index.
Hans-Peter, maybe I can try to answer this question because Jiahe studied history in college and he's viewing everything from a historical point of view. So probably that's why he's doing better than a lot of other investors. And probably studying finance is not enough. You have to study history first.
Well, I think I can give a small answer to that question.
All right.
Yeah. I mean, it's a really good question. That's why I want to answer that. I just checked the data of our portfolio performance in the past 6 years. We overran Shanghai and Shenzhen 300 index by about 16% every year. So that's amazing. And I definitely believe if I go to the Germany market or like I studied in my university in the UK, if I go to London, I can't do this at all. Never, ever. I can't do this in Singapore. I can't do this in the United States. I can only do this in China. And that's the reason, because this is a developing market. The pricing that investors make in this market is not very rational. So you see a lot of mispricing between different companies from time to time. And you say, okay, this company is good and that company is better. And you check the valuation, the better company is priced cheaper than the good company. This happens all the time. So we keep on trading between different companies and we achieve an investment return that's much better than the market. But if you go to a mature market, it's much harder to do it this way.
You understand the Chinese market better than others, probably. And to Hans-Peter, your observation here?
I'm impressed by this answer because it's a clear, straightforward answer. The
Indeed.
German market, there are also people that outperform the market, but these people are people with very high technical expertise in the respective industry.
Yeah, we've just heard Jiahe talking about the details of his investment portfolio. Maybe others, who are interested in Chinese market can copy.
I don't think so, because as he said, it is not working in a market like Germany.
No, on the A-share market.
It's not working in Germany. I don't think it's going to work in Germany, because if you check out the German market, investors are all very good and professional investors. Everyone looks at these companies, they value how much valuation that is, how the business model is going to be. You can't find the chance that people are doing wrong. So I would say, if you want a good investment record, come to Hong Kong or come to Shanghai. That's a good way.
If I would understand as much about Chinese economy as you do. But I'm not saying there's a bubble or something like that, because if I look at the real data, I see, for example, relative to the GDP, China is not on the level like countries like the United States or Japan. They have much higher market capitalization than China has. So, but overall, I think there's no mispricing overall, but in the details, seemingly there is still a lot of things happening. And for me, the question is how to develop the Chinese market. I guess it might play a role to have more financial professionals, more what you could call speculators, but people who invest into information, who invest into playing with the market, looking for arbitrage strategies. So there might be potential still to make the market more stable, which unlikely would reduce profits from sophisticated investors like you are, but that's the development of the whole market, as it maybe should be, because this means also more fair pricing and less volatility in the development.
And maybe you should spend more time here in China when you go on holiday next time. And maybe to Frank, what's your observation here? You mentioned you mentioned the tech industry. Any other sectors you see have been?
I was gonna say,
right.
Just the both side of the observation is very, very interesting. I have to say, the Jiahe's performance is impressive. You're generating a lot of very positive and healthy alphas for your investors. I want to be part of that now. But but I do want to say that I think this reason grows. It is driven by the policy and the market buys it. So let me give you one very small example, which is the pharma and biotech sectors. Since the start of the year, the Hang Seng Biotech Index has since been up by about 60%, outperforming tech, and that isn't just a speculative run. Like we see major global players like Pfizer, AstraZeneca, and Merck have signed multi-billion-dollar licensing deals with Chinese firms like 3S Bio and CSPC. And that tells you something, right? The global capital, it is recognizing China's R&D and cost advantages. And what is really driving this is the regulatory reform. So earlier this year, Beijing released new guidelines for drug and medical device approvals and cutting review times in half, and tightening supervision, and laying out a very clear roadmap to make China a global biopharma leader by 2035, within 10 years' time. And you're already seeing the result. The clinical trials are speeding up, the early stage innovation is getting a boost, and capital is flowing in. So not just from domestic investors, but international ones too in the Hong Kong market. Right. So what is different this time is, in my opinion, it's the alignment of policy, capital, and capability. Right. Yeah. So that's my opinion.
Right. This has been the Chat Lounge. But does the rally have the makings of a durable bull run? And what does it mean for global investors? That's coming up next.
The strong wind was howling and whistling.
He was the first Chinese citizen to graduate from Yale University in the mid-19th century.
I was born on the 17th of November. She had prominent features. 3 of us were old enough to lend a helping hand.
He navigated between two vastly different cultures and moved further to realize his dream and promote understanding between the people of China and the United States.
Ye was a native of Hanyang. I realized no danger. China is really awakening.
Come and join us in discovering the incredible journey of Yong Wang in his autobiography, My Life in China and America. Check out the Audible stories on radio.cgtn.com and all major podcast platforms. Just search for the podcast Books and Beyond and find My Life in China and America.
Welcome back to the Chat Lounge. We continue our chat on the rallies on the Chinese A-share market. Then, who do you see has been, driving this rally? Institutional investors or retail investors? Who's investing more at this time?
I guess from my side of the observations, again, on a relative point of view, not in absolute value. Jiahe probably can comment on the absolute value. But I think on a relative point, this time around is institutional investors that are leading the rally. And that is a big shift, right? We see domestic funds, insurers, and state-linked players that have steadily raised their allocations. But what really stands out is the return of foreign capital.
Right. Jiahe, what's your take?
I would say every time when you get a market performance, a bull market, things like this, everyone is in part of it. It's really hard to tell other retail investors are in it or other institutional investors are in it or other foreign investors are in it as well. So I would say this time I see everyone is participating. The institutional investors are definitely playing a very important part. They have been chasing the high dividend yield companies ever since last year, and this year they kept on buying them. So if you see a lot of companies paying high dividends have been pushed up, that's a lot of institutional investors behind that. And if you look at the retail investors, I think they start to rushing into the market in the past 3 to 4 months. And they pushed up the small cap indices because most of the retail investors, they love smaller cap companies, because this is a very interesting thing. Because if you go to a mature market, like we discussed before, the German market, most of the people would love blue chip or large companies because they are easier to understand and they are more predictable. But in China, many retail investors do love small cap companies because small cap companies are much more volatile and it's possible to go up higher with the same amount of money buying the shares. So that's why the retail investors are really pushing up these smaller companies. They have been growing really amazing in the past I think 1 or 2 months. And that's the time that we don't make any money because we don't buy these companies. As a family office, looking at the long term, we prefer companies with large caps and low valuation. So small caps basically are not in our portfolio. So we don't really get much money from that. But other retail investors are really happy. And if you look at foreign investors, I think quite many foreign investors are coming into the China's market in the past 2 years. If you look at Hong Kong market, where most of the foreign investors would go to in the very first place, the Hong Kong market hit the bottom, I think, in the autumn or the summer of 2023. So that's about 2 years ago. And ever since then, the Hong Kong market kept on growing up. A lot of foreign investors are starting to come in. And one reason behind that is probably because the United States started this tariff war against all countries around the world. Canada, United Kingdom, Japan, everyone. Donald Trump is just throwing bombs at everyone. So people are scared. It's not only about tariff. Investors started worrying that, okay, you can charge a high tariff on the trade today, and tomorrow maybe you can charge a high tax on our investment. So people start to worrying about their money. They try to find stable markets around the world, and they come over to China. So a lot of foreign investors are really coming into China in the past 2 years, and that's behind the large rally of Hong Kong market. So you see, everyone is really in part of this bull market. No one is really getting out.
Right. But some people...
May I say something about something very interesting you said?
All right.
About China.
Yes.
And there's one big point in that, which is good for China in a way, which is that Donald Trump is throwing bombs on everyone, because there's always a relative pricing. If he's attacking everybody with a tariff war, everybody's treated more or less the same way, everybody has the same risk, and relatively then China is better off. Whereas in the decades before, often it was mainly China which was the focus of this tariff discussion. So this might be also a positive aspect for China, that it's relatively treated better now, although for sure the trade tension as such have increased under Donald Trump. That, for me, an interesting aspect here. For sure, everybody has to pay a certain risk premium on that, but relatively this makes China more attractive. I mean, his main attack has been on Switzerland, which should be kind of ally to the United States. Instead, he's making enemies here and has a lot of aggression against Switzerland, more or less innocent Switzerland, which is not really a threat to the dominance of the United States in its areas.
Indeed, maybe that's a very important reason that attracts so many investors from overseas to this Asia market. Right.
Yeah, that's definitely right. I would say, I mean, because, United States is making itself look like a place that is not really stable for investment and long-term investment. And people start to say, okay, who is holding a stable economic policy and who is keep on welcoming foreign capital? When you come over to China and you can look throughout China's government's policies in the past 4 decades, you read all the documents, they follow each other. So they are really consistent. We always open our gates wider and wider to the global capital. Investment in China is becoming easier and easier. So people just say, okay, we choose China. I think that's the reason. I mean, you are a stable market and another market is becoming unstable. So capital is going to rush in.
And some people have
Can I
called
just
China's...
add something? Sorry. Just add something to
Sure,
Jiahe's
go ahead.
point. I mean, it's a really interesting discussion, but one thing that we haven't talked about is that the foreign investors, especially the foreign institutional investors, they don't just bring liquidity, they bring discipline.
Right.
They tend to improve governance, reduce crash risk, and anchor long-term expectations. And, there's a mountains of corporate finance research showing that, right? And so to me, the return of the foreign capital signals something much, much deeper. Not just the liquidity, but also the discipline that would, meeting the expectations.
Talking about foreign investors or foreign institutional investors, they're actually betting big on China right now. And heavyweights like Goldman Sachs, UBS, Morgan Stanley have all voiced optimism about the market. And by mid-August, qualified foreign institutional investors, that's what we're known as QFI, reportedly appeared among the top 10 shareholders of more than 70 listed firms holding combined stakes of around 6.8 billion yuan, just under $1 billion US. I'm not sure how this compares to, 2 or 3 years ago. I'm not sure if any one of you has any idea about this. What does this surge in foreign confidence mean for the Chinese market? Whom of you can take this question?
Maybe I might say something from a German perspective on that one.
All right, thank you.
Yes, that's impressive. It's a positive change for China, but there's still potential upwards. That's what I like to say. If you look at German companies, international investors, for example, play a much bigger role still. Now, Germany is a much smaller country than China. And so just from this perspective, we would expect international investors playing a bigger role. But generally speaking, I think China has still potential, can still open up more. This also means that investors generally should better diversify. I mean, it's something you've been talking about, different market segments. German investors, that's a positive trend, look more and more at the investment from a portfolio perspective, and that's a good thing. And international diversification is for sure one of the big diversification drivers we have. So I think for China, there's still potential upwards in that. And as I told you, I don't think this market is overvalued relative to the GDP. There are some countries which much higher percentage of GDP in the market cap than China at the moment still.
Fair enough. And let's talk about the opportunities and challenges ahead. Well, the ultimate question needs to be asked. Does the rally have the makings of a durable bull run, or are we looking at the makings of another bubble? I think Hans-Peter mentioned this before. We start with you?
Well, for sure. I think there is a potential for stable development. For sure, this depends on the political framework. We have a world with growing tension. If we, by cooperation of the big nations, can come back to a rule-based system where everybody is to some degree reliable, if we can come back from the use of force by big powers, both the use of war of big powers, which is happening in Europe at the moment, then I think there's a real stable basis for China for a very, very good development now with a well-diversified financial system where banks can give their share to financing the economy and where the financial markets can give their share. So there's a real good basis for that. It will depend on political decisions how much of this potential can be solved. I think internally, what I get from Frank is that China has done its homework. So the base is set for that. Let's see what happens. And from my German perspective again, I think it's very impressive that China has found that this deregulation, the efficiency in government practice, also the speed of government activities, that this plays a decisive role. I would like Europe to learn from that. This is a very helpful understanding.
Okay, Frank?
I mean, I wanted to say that that's a really good question. That's like $1 trillion question nowadays, right? Because for whether you're a participant or you're a researcher, you're always wondering, is that going to be a long-lasting bubble or that's going to just be a short bubble, right? But I think that this one feels more like slow and bold rather than a bubble.
Right.
And let's look at a possible context. So back 10 years ago in 2015, we saw a textbook bubble. The Asia market skyrocketed. I think that some indices jump over like 150%, right? And that was fueled by margin lending, retail frenzy, right? Everyone was talking about how to set, what to buy. I've got, like the textbook example, I've got family relatives who phoned me and told me how to invest. And it was very little tailored to fundamentals. And it collapsed just as fast, wiping out, I think, over a third of value within weeks. But this time is different. The Shanghai composite is up about 11% so far this year, and that is a strong run, but not an irrational one. And what is really supporting it, in my opinions, are real drivers like the economic stabilization, the AI-led tech gains, and there were targeted policy reforms. And so it's not just momentum or leverage.
True. And Jiahe, from a professional investor's point of view?
Well, I would say, overall speaking, this bull market cannot be one that will be too short-lived, because if you look at China's economy right now, it's stable. You've got a stable growing consumption market. And also what you have is that people start to lose confidence towards the price surging of properties. This has been changed. 5 years ago, everyone was buying houses, but now it's different. People think houses are not the place that you're going to make a lot of money. So people don't buy houses. And if you look at the bank saving rate, it's really low at the moment. We are in an era of low interest financial markets. If you put your money in your bank for 1 year deposit, that's about 1.2 or 1.3% rate. That's it. So basically speaking, in the overall financial market in China right now, the stocks is the only place that people have quite a lot of confidence with. And this is the place where many people are choosing to put their way of seeing. So if this process can last for 2 or 3 years, then this bull market can be pretty long. But on the other hand, we have to be aware about what's going on in the very detailed sectors of the market. Currently, I can see some degree of bubble are existing in two smaller sectors. So one sector is the tech sector, because the technology has been improving so much in China. The lives of people have been changed by all these technologies. So people are really amazed. And in stock market, the thing is that if you are becoming very excited, then in a certain degree of danger, because you buy things too expensively. And this happens with many tech companies. They are trading at a valuation that is perhaps too much. And the second is the small cap companies, because retail investors are really loving the small cap companies. Some of the small companies are really good. They're having good growth rates. They're having, overall speaking, small cap companies are trading at about 30 times PE ratio in China right now. So it's not a very expensive valuation, but it's definitely not cheap as well. So in this whole group of small cap companies, some of them are trading at 50 to 60 times PE ratio, while some of them are trading at 10 to 20. So for the companies who are trading above 40 or 50 times PE ratio, I think that's a certain degree of bubble. So people should be aware about that. But for the overall index, such as Shanghai Composite or Shanghai and Shenzhen stock indices, these small companies are taking a relatively very small part in it. So that's why I say the overall bull market can be more possible to last.
The Chat Lounge. The Chat Lounge unpacks views and opinions on hot issues in a more casual way.
And Jiahe also already shared with us his investment portfolio. Then, Frank, what kind of opportunities do you see there?
Well, the first one I was going to say is the
Biotech?
innovation driving sectors,
All right.
like Yeah, like because I believe the AI and EVs, because in Australia we see BYDs everywhere now. Last year we didn't see as many, but this year we see pretty much I think every one of the three new cars will be made by BYD. And the advanced manufacturing and clean energy, all these are grabbing headlines, right? And the second one is that I think that the China's macro model is shifting, is moving away, or at least this is what the policy guideline is, that it's moving away from a property heavy, credit driven path towards something more equity based and more innovation led. And that's opening up space, in my opinion, for long duration capital, particularly in semiconductors and green tech and high end manufacturing. And the third that is that I think Jonathan mentioned it as well, that the consumer trends are evolving. But I do want to point out that there are some other sectors like premium skincares and wellness products that are also making some promising growth. And these aren't just luxury plays. And these are the sectors that with strong policy tailwinds, with sticky demand.
Right. And Hans Peter, you are not investing in the Chinese A share market, right?
No, I'm not.
But you got your perception on the risks that could derail China's stock surge. So I'm asking your suggestion here.
I mean, first, let me say, one positive thing about these stock markets is we have a lot of volatility there without really damaging the economy. So that's what we get from the history of financial crisis. You get into trouble with your economy if the banks start to fail. Then you get really into trouble. Then things happen and you lose a lot of business and you lose a lot of work. And that's a bad thing that can happen. If the stock market breaks down, or it looks like it's breaking down, I'd say what goes down must come up later on. If the framework is okay, so that's not a bad thing. We don't have to have a permanent rise in price of the capital market. It should go up and down. These are also important signals for the economy to adjust, for the political system to change its strategies. So that's important. That's why the stock markets are so useful. They provide a lot of information to many parties in an economy. And this makes it so helpful that China has such a vibrant stock market nowadays that can really help to adjust in time. And if this is done, no damage comes from just if the market goes down again by 30%. This would not trouble me too much from historical experience I see in the history of financial crisis. So the main problem is the general political framework, as I told you, is troubling me all the time because I'm much closer in Europe to this crisis we have in the moment. We should come back to a rule-based system and not to a simple power-based system. And that's very important that this is the basis for international diversification, for international cooperation. There's a certain threat in the policies. We seem to get some positive development at the moment, that we come back to peace in Europe. To keep the system running, we need a high level of international cooperation. Peaceful international cooperation. That's where I see the main threat to the global economic development and consequently also to the stock markets in the different countries.
Indeed, that's what everybody is looking for. But whether that can be achieved is it's not up to China's say. But Frank, we've already learned about this concern on geopolitical tensions. Any other risks you see that could derail China's stock surge?
I'm probably not going to talk too much about the risk side. I think
Sure.
Peter Hank has already talked about it, and I just want to make a point related to Jiahe's earlier point regarding people has building this tension between U.S. and China into the expectations, right?
Right.
Since Donald Trump's first office, and I think that there's more to it. Well, for example, on a diplomatic side, China's trade ties with the ASEAN, the Latin America, and parts of the Europe are deepening. And then that shows a part of a clear push to reduce the reliance on US-centric flows. And even on the capital side, there's been quite a repositioning, right? Since I think 3 years ago, China's trimmed its US Treasury holdings by over 27%, and now all shifting into gold, regional assets, and even private equity. So to me, that is not just about yield; it's a signal of strategic decoupling, right? So that's so even though I would say the geopolitical risk is what in a lot of people's mind, although that's been pricing into a lot of factors, but then Beijing is pushing that away and sort of calming the investors on that end.
Right. Then do you see this as a beginning of a bigger shift that could reshape global investment strategies? Not so much.
So yeah, maybe let's hear what Jiahe thinks on that then.
Right. Hans-Peter?
Maybe I'd say my experience with many institutional investors is that they think they're very sophisticated and they believe they can get out in time if things go wrong. I have my doubts about that, but that's something which often drives bubbles. Yeah, and in this context, I'd say it's the same. I think many of them believe, well, if things go wrong, we will be out in time. So maybe it's not shaping the investment strategies too much nowadays. I think especially the big investors are often a bit careless with regard to this strategic risk, but this global strategic risk. But so maybe that's why it doesn't change too much. But I'm not sure about that. I don't see too much presence of the alternative to invest in China in Germany, but maybe that's my limited perspective in this respect.
Okay, then. A final question to you all. What conditions are needed to turn this rally into lasting growth? Maybe Jiahe?
Well, if we look at the market, there has always been, bull market and bear market, especially for, developing or say unmature market like China is having. So we're not expecting the market to keep on going forward and without any correction at all. We see correction sometimes, and we are always prepared for that.
Yes.
But looking forward in the future, I would say, with China's economy to keep on growing, which is very possible in the long term, you can expect the stock market to become better and better. Because currently China's per capita GDP is only about 13,000 USD per capita, which is lagging quite much behind countries like Japan, South Korea, even Singapore. So you can see that China is having a large potential to grow. I mean, I wouldn't be surprised if China's per capita GDP reaches 30 to 40,000 USD per capita in the long term. So with this growth, you can definitely expect the stock market to keep on growing. And for investors within the market, our job is keep on to find good companies with stable business model and cheap price. And we definitely can keep on finding these companies. But for investors who choose a different way, who choose to chase the companies with better stock performance in the short term, but very high valuation and unstable business foundation, then even the stock market goes to like 5,000 points in the future, or even 10,000 points in 1 or 2 decades time, these investors can't make money. So it's all about detailed actions when we talk about the detailed investment decisions that we are making.
And Frank?
Well, I guess from my point of view, based on the mountains of the corporate finance research done over there, I think there are two factors over here that play a big role. The first of all is the policy consistency, right? Well, investors need to trust that reforms, for example, the improved investor protection, whether it's domestic, retail, or foreign institutional, they aren't just quick fixes. Well, they need to feel like that the part of a longer term stable plan. And if there's backtracking or sudden policy shift, that confidence disappears pretty fast, and we will see the investment outflow may speed that thing up. But second, but the more important thing here is that the earnings need to deliver. Right now, the rally is concentrated in a few headline sectors like the AI and semiconductors, but to really stick, we need to see broader earnings growth. Consumers, industrials, financials. Without that, the momentum won't last. Right. And but I think and there's just one more point that Jiahe may agree or not, but the institutional capital needs to step in more. Right. At the moment, the flows are still very, relatively speaking, retail driven, but to a lesser degree. But we need to see more long-term players like pension funds, insurers, foreign capital coming, which will give the market real staying power.
Right, you talked about the policy consistency, and in terms of policies, actually Beijing has been rolling out all kinds of policies to keep the economy moving, which is the fundamental support for the stock market, from getting people to spend more at home to opening the door wider for foreign investors. So, Frank, if you had to pick just one, which do you think really makes the biggest difference right now?
I think from an outsider point of view, I think it is going to be the policy, right? As Peter Hans may add on that. From an outsider's point of view, there are a lot of uncertainties investing in the Chinese market, and much of that is the ambiguity of how you interpret a policy, and I think that plays the ultimate role in attracting the global funds.
I mean, to boost domestic consumption or attract foreign investors? Which one is?
I think
One of
China
these two, not others.
Yeah, I
Sorry.
mean, I think increasingly China's economy has integrated into the global economy, right? And I think that, it is important, to be the Asian market is no longer going to play a role just to maybe one day, we'll have an Australian company that who want to go listed in China and attract funding from China. I mean, I don't think that's going to happen in the next 10 years, but hopefully that will happen one day.
All right, then. To Hans-Peter, your take here, what conditions are needed to turn the rally into lasting growth?
Well, the market should be allowed to go up and down. That's the first thing. If we have permanent growth of stock prices, there's something going wrong. That's not the objective we should have. But for a long-term positive development, I think the first thing is the quality of institutions is crucial. And this also means these institutions must follow the objective independently. So that's a story about market regulation. If the state is always with some short-term objectives behind this might be dangerous. We have a very long-term strategy of the Chinese state. I'm very much aware of that. But still, I think it's good to have independent and strong institutions which regulate the markets. The quality of the legal system is very decisive in this respect. This creates trust to invest in a country, to invest in a market, if these institutions are reliable and stable and have a high quality. And the second perspective, I think, is for what purpose? And the purpose is for sure to have a market economy. They serve their own purpose. So if we go back to Adam Smith in a sense where they say, well, if everybody looks for himself, it is still a positive perspective coming out of this market for everybody. That's a good thing about this market economy. So the objective should be to have a market-based economy. And if these two characteristics work together, you have an immense dynamic in the long run in China with big potential.
And then one extra question to you all. When it comes to investing in China's stock market, there is always a question. The A-share market or the H-share market in Hong Kong, or the mainland market or the Hong Kong stock market. So now, which one would you choose? Tell me your answer. Hans-Peter?
I wouldn't care because all this is China nowadays. So we might have the same risk and we might have the same potential. Something for Hong Kong the argument for Hong Kong would be they have very long experience, and that might be a positive aspect. On the other hand, maybe the potential on the mainland, classical mainland market might be bigger because there's still much more growth in that. To tell the truth, I don't see a big difference because I guess many of the companies are listed on both markets, especially the larger ones.
All right. Quite a wise answer. Frank?
Well, traditionally, the Asian market has been kind of like retail driven, and the H-share market has been institutional investors driven. And I can see that there will be a point in the future that we pivot into a a convergence, right? And as what Peter Hans just said, people view them as a combined market one day, hopefully.
Last but not least, Jiahe.
Well, when we look at mainland and Hong Kong markets, we are having about 85% of our money in Hong Kong right now and about 15% in Asia. We don't hold cash. So the reason that we choose Hong Kong this much is basically because the companies there are much cheaper right now. I mean, our portfolio in Hong Kong is trading at about 6 to 7 times PE ratio. But our portfolio in mainland is trading at about, I think it's about 10 or 11 times PE ratio. So it's currently it's much easier in Hong Kong at this moment. But in the future, we definitely will change if the valuation comes to be equal between the two markets. I mean, if the valuation between Asia and Hong Kong is equal, I mean, you have all the same valuation across two markets, I definitely throw 100% of my money into Asia because Asian market is much more fulfilled with liquidity. I mean, the pricing can be misleading or wrong in some cases, where Hong Kong is more stable. You don't find a lot of investment opportunities. So if in the future, if the valuation can be equal between the two markets, then Asia is where I'm going to throw most of my money into.
Okay, that wraps up our dive into China's market rally. Once again, many thanks to Chen Jiahe, Chief Investment Officer, Beijing-based Novem Arcae Technologies, Frank Liu, Associate Professor of Finance, Business School, University of Western Australia, and Professor Hans-Peter Burghof, Chair of the Banking and Finance Department, University of Hohenheim in Germany. You can find us on all major podcast platforms. Please email us your comments at radio@cgtn.com. I'm Tiyun, joining us for more insights at the Chat Lounge next week. Goodbye.
"2,500 years ago, an old man rode on his buffalo and headed west of China. Before he vanished into the wild, he left behind a book of 5,000 words, which for the next 2.5 millennia would have shaped the Chinese way of thinking. Subscribe to the Sayings of Lao Tzu and find out why generals with wisdom yield after winning the ultimate battle, and how staying behind just might help you get ahead of others. The Sayings of Lao Tzu is available on all major podcast platforms.